Good morning and welcome to the B.F. Anderson Technical Report for August the 16th. From time to time I run across a tool, let's say an indicator, that's very helpful. And I have adopted this particular indicator here called the CBOE Options Equity Put Call Ratio. Now, what we're trying to do with this tool is try to really understand when the market has reached a period of high optimism or high pessimism. Now, if it is a secondary indicator, meaning the primary indicator is trend analysis, which we talk about all the time. So I wanted to point that out because I've just recently adopted this indicator, and it kind of brings me back to, I over the years I have developed relationships with various people across the country. And I got this idea from a guy out of Salem, Massachusetts, Mike Santolo. Mike is a smart guy. He's with Cabot, which is a research firm that we use. And Mike showed me an idea several months ago about how to use the put-call ratio. And the best way to do it is with this 15-day moving average versus the day-to-day oscilloscope that you would see if you looked at it on a daily basis. Using a 15-day moving average really makes a lot of sense to me. So if you go back and realize that we hit a tremendous amount of greed or optimism back here right around the beginning of the year, and what happened? The market went into a correction, and a fairly substantial correction. Then we reached levels of fear, and the market stabilized and started to climb. Again, we got down here as well as to the greed and optimism. So right now we basically have gotten out of a neutral zone. We are moving more into a fear zone, which I would say that the way I would use this would be if I was going to add money to my portfolio, this would be a good time to do it. If there was a stock that I was looking at that I've been waiting to buy, it might be a good time to do it. Also, on your stop losses, if you get way up in here and you just realize, there's just too much fear out there, you might want to loosen your stops a little bit. In other words, instead of saying I'm willing to tolerate an 8% decline in my stock, maybe go to 10%. Whereas down here, you would do just the opposite. So anyway, the indicator is now saying that we are pretty much in a neutral zone, actually starting to creep into a fear zone. We'll see what happens. Now, I wanted to point out some recent news that I think is incredibly important. This is S&P earnings, the earnings of the Standard & Poor's 500. You can see what's happening here. It's definitely in an uptrend. Now, in the second quarter of this year, which we are wrapping up, sales growth for the quarter year over year was 11%. Earnings beats, companies in the S&P 500 that beat estimates was 78%, whereas the historic average is around 67%. So this quarter, earnings beats were 16% above average, which means pretty good earnings season. However, I think this is the most important number. Operating margin, profit margin, 11.58%. The historic average is 8.08%. So operating margins are coming in this quarter or second quarter 43% above average. That is a big number. Anyway, interesting to know. Now, I want to talk about corrections. Now, this is the correction that took place in the S&P in February, January, February. This was the worst correction in 2 years. So we witnessed in the beginning of the year a lot of optimism about the tax cuts, and then we went into a correction. Then in April, we suffered another correction, tariff fears. So if you realize that these were April was one of the worst months for April since 1929. So I mean it was a bad month. But if you kind of step back a minute and you simply say, okay, what does all this mean to the slope of the 200-day moving average? Because this is the S&P 500 index. I'm using a 200-day moving average, and I'm circling the corrections. Gosh, you didn't even feel it. So if you would have been using a moving average to observe the market during these correction periods, you would have been pretty relaxed and pretty calm because it just shows that it was just a temporary blip on the radar. So the slope of the S&P average is in an ongoing uptrend. Looks to me to be a long-term uptrend. So again, look at the facts. Don't look at the headlines. So the trend is your friend. You just want to stick with it. Now, we don't want to leave our brains at the door. The 200-day moving average can also be very helpful in determining market tops and the resumption or the ending of an uptrend and the beginning of a downtrend. So if you go back and just see the 200-day, because I just showed you a prior graph that showed, the 200-day currently. But if we go back and we look at the year 2000, you can see the rollover and the downtrend. If you go to 2008, you can see the rollover and the downtrend. But right now, we are in an uptrend. Doesn't look anything like this. Now this actually ended this graph not recently, but I'm just making the point that if you use the 200-day moving average, it could be very helpful in periods like this and periods like this. But as I pointed out here earlier, this is what we look like today. Corrections along the way, but if you use the 200-day, you stay calm, cool, and collected. Now here is the top 5. The Advanced Micro Devices continues to look well. I understand they have new technology that is going to be somewhat detrimental to Intel. Always looking for new things. Carvana. This is a really interesting company, and I must disclose we own this stock. This is a company that has developed vending machines for used cars. And the numbers are pretty darn good. In fact, this year revenues are expected to be up 100% this year, triple digit. So hit a new high here recently after their earnings report. Their earnings came out really well. This could be a trend that we could see in the used car business, because what they do that's quite unique is they give you a 7-day money-back guarantee. So if you buy a car, you drive it for 6 days, they call you up, they say, do you like it? And if you say no, no questions asked, you can bring the car back, get all your money back, or trade it for another car. I think it's kind of an interesting idea. Now here is Turtle Beach. This is the gaming's equipment company. You can see we kind of have a pullback here that is kind of a little bit troubling. Keep an eye on it. Wouldn't buy it right now, but it is continuing to make the list. Here is Illumina, which is DNA testing. Seems to have a big future. I've known about this company for a long time, and unfortunately didn't get involved in it because it just was a difficult situation to understand. But I'm pretty much understanding now what's going on. Above the moving averages, looking good. So Illumina DNA testing. Square, which is a device that affixes to an iPhone that acts like a cash register, or you can convert an iPad into a cash register. They've also gotten into electronic commerce, which means like PayPal, where you can do electronic payments. Stock hit a new high here recently, has been acting well. So in conclusion, what I'm trying to say is that pay attention to fear and greed, because you really need to realize that I have never seen a bear market start. And I've been through, since the 70s, I've been through about 4 bear markets. And every bear market I've experienced always started with extreme amounts of optimism, and then the reckoning comes home. So let me know if you have any questions. Thank you very much.